Guys from Pizza Trading Academy. Today I'll be explaining other blocks concept in the forex market. So please do like, subscribe, comment for more strategies and informations like this. And also in the description below, there's a link there to join Trading Academy. You can also join our other social media platforms on Twitter, Instagram. And also, if you're interested in joining our Trading Academy, the WhatsApp link there is below in our description. So please do contact us. Thank you. So let's go straight into this. Now, what are other blocks? Other blocks are simply just places or region in the market whereby orders of the same type were taken. So what do I mean by orders? Like buying or selling. And since they are of the same type, so it means it's just one particular order. So for example, if a buying order was taken at a particular region, definitely we are seeing the market buying seriously from there. Now, some people do feel other blocks is a kind of smart money region, whereby the big guys, big players, came into the market and moved the market in a particular direction. Yes, you can say it's something like that, but for me, I feel smart money, the big guys, and we the retailers, we are the same. Because there is this concept about that, you know, there's retailers mindset and the smart money mindset and this and that. I don't believe there's something like that. Everybody, we are all trading the same with the same mindset. Everybody, even the big guys, they analyze the same way we do. They do everything the same way we do. The only difference between we and them is the fact that their equity is so large that once they come into the market, you will see the market moving very in a very mad way. But we, our equity is so small that even $100,000 account can't move the market. It can't move it. So definitely, the big guys, they trade with millions of dollars. So that's why when they come to the market, they move it in a very big way. So, but not that they have a different way of trading on their own. It's the same analysis and everything that we do. But calling other blocks smart money move or whatever is not actually a wrong definition. It's also still right. Now, other blocks, okay, you might say that fine. Other blocks and then support and resistance levels, they have something in common. Yes. For example, now, let me go into this particular region that I have here, this particular place. Now, above there, I can easily just draw a line there and call it resistance. Of course, price reached there and it came back. It went there again another time and it came back. Fine, there is no problem. You calling that a resistance level. But there are some points whereby if you just put it as a line alone, in fact, you are going to get caught by something they call liquidity grab by smart money. So that's why other blocks and smart money, they kind of have something in correlation. So I want to use a particular place in this chart to explain that. Okay, very fine. Something like this now. So this particular region, this line that I have here. Now, normally, if I were to use, so I'm just trying to explain the importance of other blocks over support and resistance levels, because in my last video I talked about support and resistance levels using trend lines and but other blocks are still more preferable. So you can see on this chart, I'm just drawing only lines. I just did it for you know explanation reasons. So now other blocks are more important. They are better than just drawing ordinary lines because of liquidity grab. So liquidity grab is a kind of move caused by smart money. Definitely the forex market is a very liquid market, especially currency pairs. They are very, very liquid. Liquid in the sense that it can be easily bought and sold. So you see that's why currency pairs, they move up and down. They don't just go up, down like for a very long. They move up and down, up and down, up and down because they can be easily bought and sold. So apart from maybe the period of news or something like that that can just move it in one direction only, but you see currency pairs going up, down, going up, down. So that's what liquid market means. So now what they want to do there is that probably now, so I will explain liquidity grab. Now, liquidity grab is in the form that these guys, the smart money, like I said, they do analyze just like us, just the same way, like our same analysis. That's what they do too. But them, they trade with a larger equity and they prefer taking long positions. They don't trade for short term like they just scalp the market. No, they trade long terms. And the market is very liquid. Is buying and selling, buying and selling. And so they can't just come into the market and just buy or sell as with their analysis that they've done. Now what they do is liquidity grab. Now definitely, so I'll move over to this place. Now for example, let's say our chart was around here. If our chart was around here, probably it's coming down, and we've drawn this particular line here up to this point, knowing that definitely this is our support point, and we can also use it as an RTO, like I explained in my last video with test to return to origin. So definitely now, what would most people do? They will put their buy limits there. Some people can put buy limit, or some people just wait for price to reach there and just buy immediately. So some people put buy limits on that particular line, and where would stop loss be? So if you put your buy limit here, definitely our stop loss is going to be somewhere maybe around here or very close to it, depending on how you are managing your risk and every other thing. Now, liquidity grab is a form of stop loss hunts. They also call it stop loss hunts. Probably you might have heard of something like that, stop loss hunts. In the sense that they're going to push the market a bit lower to where people's stops are. They'll push the market down to where people's stops are to make the market free of buying and selling, to make it very free and making sure that they are the only ones that are in the market. So definitely once the market is free and is not so liquid as it was before, they can easily take their position without any danger or anything. So definitely, you as just a normal trader, you put your buy limit here, or once price got there, you just put your buy and you're expecting it to go up. But just saying that, oh, this market is going down, it's going down. It even reached my stop loss and took me out. And probably you might have put another sell, thinking that okay, maybe this market is probably selling, and you just put your stop loss here again, and you find it going back up again, it's hitting your stop loss, and you are just confused that what's going on. Now that is the case whereby trend lines for support and resistance won't work. Now what they just did here was liquidity grab, stop on, like I've explained, to make the market free of liquidity, so that they can come and take their long positions. Now other blocks will have been more preferable if you've drawn an other block instead of just a line. Other block is just drawn with rectangles. You just draw a rectangle. Now if I were to draw my other block from here, I'll pick it from this support line below. Okay, I didn't know that way. Down to just a little bit below the low there, and just draw it here. So I have that. Now definitely, as I was saying, remember, if our market was still around here, it's still coming down with that kind of force. Now when you are working with other blocks, what do? You don't trade until when market comes out of that zone. While market is in that zone, just let it do whatever market wants to do. Now have you seen that okay, the market is coming down, it's coming down, it has hit your support level already, but it's in your zone, abi? Fine. You can see The market entered the zone with a bearish candlestick, of course. Then the next candlestick was, bullish. Now, but the bullish candlestick still closed inside the zone. So definitely that's not a sell for us. Next candlestick was still bearish, was still inside the zone. Next one was still bearish inside the zone. Next one is bullish, still closed inside the zone. Now you can see the driving force back up and it's closing outside the zone. That is where we're actually supposed to take our buy limit. So you can see with other blocks, it's more preferable. You can easily place your trades with so much confidence that, oh, this is where this market is going to. So the market closing above that particular zone gives us clear assurance that definitely this thing is a buy. And of course, I've explained in my previous videos. You can check my YouTube channel for the previous videos, that whenever price should close above a zone, or a line or whatever, there will be a retest. No matter how little or big it will be, there must always be a retest, then a continuation in the trend. And you can see that's exactly what you know um happened here. Price broke out, retested with bearish candlestick, and even the retest still closed above the zone. It still closed above it. So definitely, if you have taken our buy at the close of that candlestick, at the close of the candlestick here, definitely we can see how the market just continue going, and definitely we can pick our take profit from whatever zone that we have up already. So that's how um other blocks work, and is more you know preferable than just drawing lines and getting caught by stop stop loss on liquidity grab and whatsoever. So that's just all I want to explain in this video. I hope you enjoy it.